The hidden cost of stressful investing. Most investors measure performance in percentages. 8% return, 15% growth, minus 20% drawdown. But few measure the invisible variable. Psychological cost. Stressful investing carries hidden expenses that rarely appear in brokerage statements, yet they compound just like returns. Let's examine the research behind the unseen price. 1. The biological cost. Chronic stress is not neutral. Market volatility activates the body's stress response system. Cortisol release, elevated heart rate, heightened threat sensitivity. Neuroeconomic studies show that financial losses activate brain regions similar to those triggered by physical pain. Behavioral economist Daniel Kahneman demonstrated that losses are felt roughly twice as intensely as gains. In a volatile strategy, emotional pain frequency increases. Physiological stress accumulates. Chronic stress is associated with sleep disruption, impaired immune response, increased anxiety, reduced cognitive clarity. These are biological costs, not theoretical ones. 2. Cognitive bandwidth depletion. Stress consumes attention. When investing becomes emotionally intense, it drains focus, working memory, decision-making capacity. Psychologist Roy Baumeister has written extensively about limited self-control and decision fatigue. Constant monitoring, checking prices, reading financial news, watching charts. These activities consume mental bandwidth that could be used elsewhere: career, relationships, creativity. The opportunity cost of attention is invisible but significant. 3. Reduced decision quality under stress. Under stress, the brain shifts toward fast, emotional processing. According to Daniel Kahneman, this is the dominance of System 1 thinking: reactive, impulsive, short-term focused. Stress increases risk aversion after losses, risk-seeking after recovery attempts, short-term decision cycles. This leads to overtrading, panic selling, performance chasing. Ironically, stress not only costs emotionally, it reduces returns. 4. Action bias amplification. When markets move rapidly, investors feel pressure to act. This is known as action bias, the tendency to prefer doing something over doing nothing in uncertain situations. Research by Barber and Odeen found that higher trading frequency is associated with lower average investor returns. Stress increases action. Action increases cost. Cost reduces performance. The hidden cost is behavioral deterioration. 5. Relationship and lifestyle spillover. Stress does not remain in the portfolio. It spills into conversations, mood stability, sleep patterns, work performance. Emotional volatility from markets can affect irritability, withdrawal, reduced patience. Financial stress is among the most commonly reported stressors globally. Even profitable but highly volatile strategies can create unstable emotional environments. 6. Hedonic adaptation. The pleasure fades, the stress persists. Psychological research shows humans adapt quickly to gains. A large profit excites briefly. Soon it becomes the new baseline. But anxiety from potential losses often remains vivid. This creates an imbalance. Gains normalize. Threat sensitivity persists. Over time, stressful investing can feel like continuous vigilance with diminishing emotional reward. 7. Identity fusion increases emotional exposure. When investing becomes part of identity, gains validate competence. Losses threaten self-worth. This intensifies emotional reactions. Instead of, the market dropped, it becomes, I failed. Identity fusion magnifies the psychological cost of volatility. 8. The compounding effect of stress. Financial returns compound. So does stress. Years of high-alert investing may lead to burnout, strategy abandonment, risk aversion at the worst possible time. Long-term investing requires emotional sustainability. If stress accumulates faster than discipline, the strategy eventually breaks. 9. The illusion of higher return. A strategy delivering 18% annually but causing chronic anxiety may, in practical terms, be inferior to a diversified 8 to 10% strategy. Low monitoring frequency. Predictable structure. Because real return should consider financial return, emotional cost, time cost, cognitive drain. The highest nominal return is not always the highest life return. 10. Stress as a risk signal. Persistent stress often signals excessive leverage, concentrated positions, misaligned time horizon, overexposure to volatility. Peace is not weakness. It can indicate proper risk calibration. A calm strategy is often a sustainable strategy. Conclusion. Stressful investing carries invisible costs. Biological strain, cognitive depletion, behavioral mistakes, relationship spillover, reduced long-term consistency. These costs rarely appear in performance reports, but they shape outcomes. The best investment strategy is not only the one with the highest expected return, it is the one you can follow calmly for decades. Because in the long run, emotional sustainability is a performance advantage.